Welcome back to the session about risk-adjusted return on capital and the concepts of risk appetite and relationship pricing. We go right into the subject and pick up where we left off in the last session. We have left with an example of a $10,000 loan with a 5% probability of default, a 40% loss given default, a 50% exposure at default, and a 4-year maturity. Our loan requires a total amount of equity capital of $1,066.49, of which $100 is a reserve in the form of the expected loss, and $966.49 is the unexpected loss. Another word for the unexpected loss is also the economic capital. Additional factors used in this calculation are the confidence level, which we set at 99.9%, which means that the capital of the institution should be sufficient to not default in 999 out of 1,000 years. There's also a scaling factor that can be adjusted away from 1 if we assume that the risk should be estimated higher or lower for so far unconsidered factors. A higher scaling factor could, for example, apply to a portfolio that is very correlated. The unexpected loss or economic capital is a factor that we will use later in the risk appetite concept. Given that we now have an indicator about the risk related to a specific loan in the form of an equity contribution, we are in the position to calculate the risk-adjusted return on capital, or RAROC. Conceptually, the formula for RAROC looks like this. We look at all the revenues that are generated from the loan. This could come from interest income or fee income. And we put all expenses against that. They usually consist of operating expenses, expected loss, and funding expenses, meaning the cost to borrow funds to finance the loan. Further, we need to credit back the capital benefit. Capital benefit refers to the fact that our loan is not fully financed by borrowed funds. Parts of the funding, namely the amount equal to the unexpected loss or economic capital, comes from equity. As we want to calculate the return on equity, we do not charge funding costs for that part. Let's look at some numbers. Let's assume that our loan carries an interest rate of 10%. In addition, we have a 1% disbursement fee, which we distribute over 4 years. We assume that the interest income is $1,000, as the loan amortization happens at the end of the first year, and $25 for a quarter of the fee, as we distribute it over 4 years. We assume operating expenses of $300 per year based on input from the finance and operations team. And we look at funding cost of 5% or $500, as based on our treasury department, this is the amount against which we borrow money currently. We also calculate the capital benefit of $48.32, which is equivalent to multiplying the $966.49 of unexpected loss with 5% of cost of funding. Our total revenues are $1,073.32 against total expenses of $900. This leaves us a positive income of $173.32. Dividing this income by the total unexpected loss of $966.49, we can calculate a RAROC of 17.93%. This method is most transparent to document the actual return an investment can achieve. In this case, of course, it is the decision of the bank to make that loan to a customer, assuming that the 17.93% RAROC are considered sufficient returns. Let's have a look at a few scenarios to play around with the calculation so far. What happens if we increase the size of the loan but leave all the other terms and conditions unchanged? If we double the loan amount from $10,000 to $20,000, our RAROC will increase. The reason for this increase is the assumption that our operating expenses remain stable. That's actually a fair assessment, considering that the bank most likely has the same operational effort to provide a $20,000 loan versus a $10,000 loan. We can also see the effects of an increase in the risk of an exposure. This is expressed in the probability of default. Our initial loan had a 5% probability of default, resulting in a RAROC of 17.93%. If we increase the probability of default to 6%, the RAROC goes down by 2.6% to 15.3%. You can see the significant effect a change in risk profile can have on the profitability. The reason for this increase is the unexpected loss that goes up from 966.49 to 1021.75. At the same time, the expected loss grows from 100 to 120. The increase in economic capital also led to a small increase in the capital benefit, which does not significantly influence the end result. An interesting side aspect here is the fact that the profitability of the loan can vary for the institution over time, as the risk profile of the client can change over the 4 years of the loan term. What happens if we increase the collateral of the loan? In this case, we can improve the loss given default. Let's assume that the borrower is able to provide us another collateral and thereby reduces the loss given default from 40% to 20%. And this adjustment significantly reduces the economic capital allocated to the transaction, almost by half, down to 510.88. The expected loss also decreases. The total revenues have increased due to the reduction in expected loss, resulting in a significant increase of the RAROC to 37.3%. Based on these 3 simple examples, you can already see the potential that lies within the formula to steer the overall financial institution. This is really powerful and has many use cases. Let's look at 2 of them. The first one is the risk appetite. As a background, financial institutions tend to optimize the processes and workflows to improve efficiencies. When it comes to assessing credit risk of a counterparty or a transaction, such improvements reach a limit when the thoroughness of an assessment competes with the speed. If we assume that we have to assess the credit risk for a specific transaction, and there are many reasons to do that, then our attempt to optimize the turnaround time reaches its limits. We still have to do our manual work, we still have to make the assessment, we still have to write the documents for the committee, and so on and so forth. At the same time, we are conscious that we are preparing the financial institution for a fully upgraded business strategy. Such a strategy should be complemented by the definition of a risk appetite, because this then allows a faster approval process. A financial institution's risk appetite is typically defined through a combination of quantitative and qualitative factors and is influenced by risk tolerance, business strategy, regulatory environment, and the overall risk management framework. If designed and executed well, the risk appetite will help to establish a clear boundary between which the financial institution could operate without exposing itself to excessive or unacceptable levels of risk. Developing the risk appetite is an exercise that is best done with an outside advisor or consultant, such as those provided obviously by Q-Lana. There are several components that are combined to the development of a risk appetite. We start with risk capacity. Risk capacity is the maximum level of risk that an institution can take before breaching constraints related to regulatory capital, liquidity, and other operational restrictions or external obligations such as covenants. The risk capacity clearly sets the framework for an institution's ability to take risks. The actual risk appetite is the aggregate level of all types of risks the institution is willing to assume within the framework of its risk capacity. The risk appetite needs to be aligned with the perspective to achieve the strategic objectives and the business plan. Risk limits are quantitative measures based on forward-looking assumptions that allocate the financial institution's aggregate risk appetite statement to the business lines, to legal entities, to specific risk categories, concentrations, and so on. The overall risk appetite is, of course, influenced by multiple factors, such as the regulatory and compliance considerations. The risk appetite should be in line with the regulatory requirements and guidelines. Financial institutions need to ensure that their risk-taking activities comply with the relevant laws and regulations. The risk appetite is closely tied to the institution's business strategy. It outlines how much risk an institution is willing to take in order to achieve its strategic objectives. For example, a growth-oriented strategy might involve a higher risk appetite compared to a strategy focused on stability and preservation of capital. Risk appetite can also be influenced by the expectations of various stakeholders, including shareholders, customers, regulators, and the broader market. The risk appetite statement helps shaping the institution's risk culture by setting expectations for risk awareness, communication, and behavior across the entire organization. The most straightforward way to quantify risk appetite is using the economic capital or unexpected loss as the unit of measurement. The institution can first assess the total amount of economic capital it needs for its current operations and its current risk profile. In this exercise, the institution can also better understand where, meaning in which categories, in which sectors, in which regions the risk is allocated to. The existing risk profile can then be compared to the target profile derived from the business strategy and other input factors mentioned above. With this, a potential shift in risk allocation is defined and executed. Changing a risk profile for a local or regional financial institution can be a slow process, particularly as the shifts in credit risk can only happen through natural maturities and the allocation of new business. This is different from a hedge fund or an investment vehicle where changes in risk appetite and profile can happen through trading activities. Now that we have a new target allocation of the risk appetite, these numbers can be broken down into sectors, products, and regions, but ultimately also to individual counterparties. If done well, you define a very specific risk appetite in the form of economic capital allocation to a borrower, and then you can leave it to the business to fill this appetite with a specific combination of products and collateral. At the time a new transaction is processed, the risk appetite helps accelerating the credit decision as it is clear whether there is capacity to take on more risk. It is required, though, that the institution regularly updates the borrower's risk profile to understand the actual economic capital allocation and that there is an escalation mechanism to handle exceptions. As a result, not only does our institution have a much better business strategy, but it also has significantly upgraded its way how to assess and allocate risk to the businesses. This brings us to the second concept, the relationship pricing. Traditionally, financial institutions used a fixed pricing table to quote interest rates and fees for their financial products. This approach neglected the overall relationship component and led to missed business opportunities. In the framework of the customer-centric banking operation, the key focus of the pricing for a financial product is on the overall relationship. The financial institution needs a pricing model in which it can derive at any stage the actual and projected revenues for a business relationship on a standalone basis or consider additionally related clients. For example, the pricing of a financial product of a company could be lowered if the employees of the company also maintain a relationship with the institution. For this purpose, the pricing concept of a risk-adjusted return on capital is best fitted. Let's go back to the concept and the calculations we have introduced before. The overall revenues per product and the direct costs are considered. The total amount of risk capital consumed in the client's relationship and the target returns are calculated. The methodology to calculate the overall risk mirrors the calculation of the risk appetite as defined before. Having such a system online and in real time available allows the institution to adjust pricing on an ad hoc basis for specific clients to secure an overall beneficial relationship. Let's look at an example. We start with the loan from before. It achieved a 17.93% RAROC. Let's assume that we add to this client a current account for the borrower and his wife. We charge 10% per month per account and estimate $5 per account and month as cost. Since the current account does generally not add to the credit risk, we don't need to adjust our risk capital. Through these additional revenues, the RAROC increases to 30.35%. In case the client demands it, we could lower the interest rate on the loan by 1% and still be more profitable than without the current accounts. You can see already the potential of this calculation if the data is available and if the tools are in place. This concludes our deep dive into some of the concepts of our business strategy. In the next chapter, we look at some of the tools and partnerships that help you implementing the business strategy. Looking forward to see you in the next video.